And you have a co-invest program. Maybe you could explain to the audience what that is and why it exists. Because if you're betting on managers to do all this work, and then managers understand what the winners are because they work with them on a consistent basis, and they have more money to deploy, then I've always wondered, well, why not stick with that? Why try to do the job of the GPs that you are working with? So maybe you could give your best explanation for that, because I hear different, people could steal me on it and argue each side. So argue the side, I guess, of having a co-invest program.
Yeah. And I think it's been an interesting trend to watch where most strategies that are, say primarily a fund-to-funds type strategy are doing this in some way, shape, or form. For us, our co-investment program right now is a part of our overall fund strategy. So 10 to 20% of our fund will be for co-investment opportunities. What does that accomplish for us? Well, it has the benefit of a few things. Number one, it usually blends down fees a little bit, right? And so if a manager charges, say, 2 and 20 or a little bit higher, depending on the manager, at the baseline for their fund, it might be 0 and 10 or 1 and 10 or 0 and 20. There's any range of outcomes there. So it does help blend down fees a little bit, and it creates faster DPI. I think one of the most difficult elements of venture is it does take a long time. And frankly, it's gotten longer in terms of that time frame, the way companies are staying private for a longer period of time. And it's double-edged sword. Because they're private for longer, you want to access them in private markets where more value creation happens, but it can take a little bit longer to ultimately end up with an exit. And so if you include a bit of co-invest into your portfolio construction, then you'll be able to hopefully generate some faster DPI for our investors. So that's a big part of it. I think the second element is, when we're talking to fund managers, and this should be true across asset classes, you ask the question, like, what's your right to exist? Why should I give you my money? With every investment I make, there's an opportunity cost where I'm not investing in someone else. We look inwards and ask ourselves the same question. Why should people trust us in the venture category? It's because we've got pretty unique access and what I think is a fantastic portfolio. Why should they trust us in the co-invest category? I'm not going to pretend that we are as good as many of our I'd expect probably any of our GPs that we've invested in.
Hopefully not. That would be,
hopefully not.
That would be like a misalignment. If you suddenly became better than the GPs, it would be like the manager of the restaurant being better at cooking the steak. Yeah, not the way it should work. Yeah,
no chance. But what I'll say is, we also get the benefit of that ecosystem. So I'll give you an example without mentioning names specifically. But we looked at a co-investment opportunity in a really interesting business just a couple months ago, and within 5 days, we had talked to 5 of our fund managers and a few others about the opportunity, many of which who had seen it, many of which had looked at it at an earlier stage. And so we can actually kind of extend beyond the talents of our team and benefit from the broader ecosystem that we're now a part of in terms of really selecting the best co-investments. And that's important because there is adverse selection within the co-investment world. If you are a GP, you're not always going to want to give away your best deal. You want to back up the truck. And to the extent that there's any additional room, then sure. And so part of the magic of the co-invest is we don't really want the stuff that GPs aren't fully leaning into. We want the things that, okay, they are fully leaned into, but this is the allocation they got, or, there's no more room left in the fund, or concentration limits or whatever. And having that benefit of being able to discuss that with the ecosystem really helps us hone in on that.
Yeah. And this is the great paradox of what we do for a living. We deal in, an asymmetric information environment where people are making trades on insider information. Not illegal in public markets. In private markets, that's the entirety of what we do is, private companies do not give their information to the public. They're not out there, and it's hard to get that information. So if you have 5 fund managers, 3 of them own the shares in this company. They did the seed round, the Series A, the Series C, and you're trying to do the Series D. Man, what an advantage that is. And you have the 2 people who passed on the D or this current round, and they tell you you're thinking. Pretty amazing. But, there's also something there. It could be adverse selection, but I think you have to double click on it, don't you? Because it could be, well, if I was the seed investor and I own 10% of the company and I'm up 200x, 400x, do I really want to add on to that position? There might be a case for it. There might be a case for that seed manager to deploy that company in what they think is the next Uber, Robinhood, Coinbase, DoorDash, whatever it is, right? So it does take a little double click.
And you get into, reserve math too, where there's a lot of seed and Series A who, firms or pre-seed firms, all of these groups who have some sort of capital reserved for follow-on investments, right? And that also may be an area where, hey, we'll invest in seed primarily, and then we'll do follow-ons in A, but we're not doing anything after the A. It's just not consistent with our strategy. Our opportunity cost, if we do Bs and Cs, is that we can't put it back into finding the next Uber or the next DoorDash or whatever it is. And so that's absolutely a factor. It's not always adverse selection. There can be a number of things, but to your point, you really got to drill down and understand it.
Yeah, I mean, I've been having this conversation a lot as a pre-seed and seed investor with our fund, because the question I'm getting from a lot of LPs is, when do you start liquidating? And, my answer to them is, when we have the opportunity and we're up 50, 100, 200x, we're going to take 10% off the table, even if we think it's still a rocket ship. Because my experience with Robinhood, with Uber, a company worth 14 billion, 150 billion, is, if you can take off 10% in year 6, in year 9, in year 12, and get that money into the pockets and get that DPI locked in, that the cash on cash that a lot of investors are looking at, and, how much did I invest in this firm? And then how much did they actually give me back in cash? We're really, cognizant of that. It's one of the wonderful things. I mean, just, during this holiday week, a lot of people are off. I've been giving some thought to this. My Lord, it's incredible how functional our ecosystem is. The seed investors are making these crazy bets, pairing their positions, but then there are these later stage investors who want those shares. And then there's a public market after that. And then there's co-invest. And, in some ways it's so vibrant, and the transactions are happening at different stages with different goals. I'm not saying it perfectly, but, now that I've been doing it and going into my second decade, you start to see the chessboard a little bit more, and it's beautiful. It's just a beautiful symphony of risk-taking, like unbelievable, insane risk-taking, which is what I love about it. The fact that we can tell people with a straight face, we're going to invest in 100 companies. 2 of them, based on the power law, are going to be 95% of the returns. And they're like, which 2? And I'm like, I mean, I could tell you what I think, but if I'm being candid, historically, when I look back on my track record, the idea that a taxi cab company and a stock trading company where you don't pay to trade stocks and a meditation app would be 3 of our biggest returns, I would be like, kind of lying. We thought they were really great teams. Don't get me wrong. It was clear they were going to be winners.